China, the world's second-largest economy, is facing a moment of reckoning. August data shows a sharp slowdown, casting doubts on Beijing's ambitious growth targets for 2025. From faltering manufacturing to weakened consumer spending, the signs are hard to ignore. Today, we'll break down what's happening in China's economy, why it matters globally, and what it could mean for the months ahead. August was a tough month for China's economy. Industrial production rose just marginally, retail sales growth slowed, and the real estate sector continues to struggle. Experts warn that these numbers are a clear signal that China may miss its growth target of around 5% this year. The slowdown is not isolated. It reflects structural challenges, declining consumer confidence, and lingering effects from recent regulatory crackdowns in technology and property sectors. Manufacturing, long a driver of China's rapid growth, is showing signs of fatigue. Factories are facing weaker demand both domestically and abroad. Export growth is slowing, partly due to global economic uncertainty and higher interest rates in major economies like the US. Companies are cautious, inventories are building up, and investment in new projects is declining. Analysts suggest that unless demand picks up soon, this trend could further drag down GDP growth in the coming months. Consumer spending, which accounts for more than half of China's GDP, is also under pressure. Rising unemployment in certain sectors and a cautious middle class have led to slower retail growth. E-commerce, once a strong driver, is also showing signs of saturation. Analysts warn that without a rebound in consumer confidence, the recovery could remain uneven, further complicating Beijing's efforts to stimulate the economy. The property sector, a cornerstone of China's economic growth for decades, continues to struggle. Major developers face debt pressures while buyers remain hesitant. New housing starts have fallen and sales are weak, affecting construction jobs and local government revenues. The real estate slowdown is a critical factor behind the August slump and could weigh on growth for the rest of 2025. In response to the slowdown, the Chinese government is signaling a mix of policy tools. From interest rate cuts and tax relief to targeted support for struggling sectors, Beijing is trying to stabilize growth. However, analysts caution that policy measures may take time to show results, and there are limits to how much stimulus can offset structural economic challenges. China's economic slowdown isn't just a domestic concern, it has global consequences. Slower Chinese growth affects demand for commodities, impacts global supply chains, and creates volatility in international markets. Countries heavily reliant on exports to China, from Australia to Germany, are watching closely. Investors worldwide are assessing whether China's growth slowdown is temporary or a longer-term trend. So, what's next for China? Most economists believe growth will remain below expectations for the rest of the year unless consumer spending rebounds, the real estate market stabilizes, and exports pick up. While short-term measures can provide some relief, China faces a delicate balancing act, stimulating growth without creating new debt or bubbles. The world will be watching closely as Beijing navigates these challenges. China's August slump is more than just a monthly statistic. It's a reflection of deeper economic shifts. For businesses, policymakers, and investors alike, understanding these trends is crucial. As the world's second-largest economy recalibrates, the coming months will reveal whether China can regain momentum or face a more prolonged slowdown. Stay informed as we continue to track this critical story.